Hi everyone. Could be a great opportunity here in the stock market with Rightmove. So I saw that Rightmove had 100% gross margins. Their share price has dropped a lot recently. I'll give you my thoughts on Rightmove and whether it's a stock to buy in this video. Have a look. So these are the 5 key areas I'm going to review for Rightmove. Looked into, I'm going to share my thoughts with you on them. Let's start with the chance of failure. I'm only going to buy a share in a company if there's a low chance of failure. That's how I want to work for my portfolio. And with Rightmove, they've got a very low debt to equity ratio. That's just 14%. Dividends are very affordable. The payout ratio around about 30 to 35%. So they're not stretching themselves. And they very much are a sector leader. So they're less likely to fail than some of their competitors at the point. I found that their interest cover is incredible. That cover is over 500 times. So the debt that they do have is barely a speck in the ocean. And their current ratio is over 2. And in fact, in the last 5 years, it's averaged about 2.6. They've got very good ability to pay their day-to-day bills. As far as I'm concerned, this is one of the best companies I've seen. Low chance of failure. And that's just my opinion, of course, not financial or investment advice. Do your own research, but that's my view. Now look at the second measure. And that second measure is to look at the quality of the company. And the return on capital employed, incredible for Rightmove. So incredible that it's actually over 300% at the moment. Now, you're normally looking for 20% minimum, 30% or above is good, very good. 300%, so very good. And of course, their gross margin is 100%. How does that go down the profit and loss statement? Well, their actual operations are profitable as well. And they're always above 60% operating profit and recently above 70%. So that's fantastic operating profits. They are very good at converting that profit into cash. Cash conversions over 100% at the moment. And of course, they are the leader, so they've got a moat. So they're the leader in the UK, at least, in what they do. It's a property portal. So for me, this is a high quality company and is worthy of further consideration. Thanks for watching up to this point so far. Very quick interlude to thank my Patreon supporters. If you'd like to join them, get access to the Discord server. We can discuss stock ideas, do some analysis together. Please check out the link in the description below. Very much welcome you and look forward to seeing you there. Thanks for watching so far. Back to the video. I do look at some other factors like, is the industry suitable? I think it is. The industry is suitable, and certainly you can say that there's going to be transactions in homes and renting for the foreseeable future. It's something that people have a need for going away. They do pay a dividend as well, and that dividend is relatively low, look at 1.5%, but it is affordable, and this isn't a dividend stock. Why would you pay a massive dividend if you're so good at reinvesting back into yourself? So that's all fine. They are doing some buybacks. Now, whether they've been buying back at the right price is another question. But their shares outstanding seems to drop by sort of around about 2% per year. So they're going to grow it. If that carries on, they're going to grow at 2% per year minimum anyway. And future growth is predicted. Now, on Simply Wall Street, the future growth is about 5% a year. And the Yahoo analyst page is looking at about 7% a year. So I'm going to use 6% as my future growth figure. Now, of course, it is worth noting there's going to be elements of cyclicality, this sort of company, because it's tied into the property market. And that, of course, is tied into, to an extent, economic confidence and interest rates, cost of living as well. All of that sounds good to me. It's a company I'd like to own. Is the valuation sufficient for me to purchase at the moment? Now, I want to make a minimum 6.66% a year to get to my long-term £1 million goal, but actually I want 10% a year because I get there 10 years quicker. So can I get 10% a year from this company based on my valuation? Now, using that growth rate of 6%, my discounted cash flow valuation comes out at 9.4% per year at the current price. I'm not quite there. To get it at, so the market price at the moment is £5.41 as of recording. I need it to get to £5.28 to get a 10% a year return. So I'm pretty close. So that's one method of valuation. Second method of valuation, I call it the Terry Smith method, is you had to take the free cash flow yield, which I estimate at 4.37%, and you add the growth rate, so add 6% to that. That's actually just over 10%. So that's 10.4% return per year at the current price. So my estimated return range is between 9.4% and 10.4% a year, which is fine, roughly what it to be. Of course, within that, there is no margin of safety. This company is so unlikely to fail and of such high quality that maybe a smaller margin of safety would be acceptable. But of course, we don't know what shocks could happen in the future. So, just to give you a bit of context, to get to a 15% a year return, I estimate that by discounted cash flow, you need to be at £4.36. And via the Terry Smith method, we would need to be at £2.63. My decision is certainly that it fits my portfolio structure. It's a high quality company and it is better than some of the companies I've got. It certainly looks at home in my quality portfolio pot. I've got a 19 or so percent cash position, 18 to 90%. That's too high. It would be a good use of that position. Ladies and gentlemen, a brief interlude to talk about Mint Architecture Limited. Amazingly, the very first sponsor on this channel. Are you looking for some consultancy for any building project? Extensions, loft conversions, barn conversions, or even commercial projects? Whether it's large or small, Mint Architecture Limited can draw upon over 15 years of experience and knowledge to help you with your project. Contact Emily, Mint Architecture Limited. Details will be posted below for your free consultation and bespoke, no obligation quote. So thank you once again to Mint Architecture Limited sponsoring this video. Returns just about the required range, and my theory is I think I'm going to buy a starter position at 0.5% of my portfolio. Now, that's at current price of £5.41. Now, when it gets down to £4.73, I'm going to double that position to 1% of my portfolio. When it gets down to just under £4, £3.94, I want to double it again, 2% of my portfolio. Then finally, if it somehow goes down to £3.38, I'm going to double it again, 4% of my portfolio, and then that will be the cap. So that's my strategy for this company. Now, I've done all my analysis, I've done my decision making, I'll now finally look at a price chart. Here is the price chart for the last 2 years. We can see actually it peaked at getting on for about £8 per share, so we're way down on that peak. It did drop towards the end of last year down to sort of £4.50 or so. In fact, if we zoom in here, we can see that it dropped to £4.45, and that's certainly below the second buy point for me. So, I've missed a buying opportunity there had I looked at this last year. So I've been a bit slow off the mark, but that's fine. We can't catch everything. And, it's had a drop off recently as well. That's the end of the video. Click the link on screen to see my full portfolio review and how Rightmove would fit in to the rest of my investment portfolio.